What happens when I take money out of a Roth 401k? Hi, I'm financial planner Sean Mullaney. Let's discuss. So, Roth 401ks, tax-free growth in a retirement account. What is not to love, right? However, we do have to think about making sure that any distributions from the Roth 401k qualify for tax-free treatment. And if we think about, hey, we take money out of a Roth 401k, the tax law says, well, that's one of two things. It's either a so-called qualified distribution or it's a non-qualified distribution. And the easy one is the qualified distribution. We always love qualified distributions if we are both 59 and a half years old or older and we've had that particular Roth 401k for 5 or more years. Guess what? We get to take money out as a so-called qualified distribution, and that means we pay no taxes and no penalties on the withdrawal, no questions asked. Great result. Qualified distributions, fantastic. Okay. Well, what about this scary sounding non-qualified distribution? That doesn't sound good at all. It sounds like the IRS is going to drive up and take me off to jail because I took a non-qualified distribution. Well, not so fast, right? If your plan allows it, right, you actually have to look to the terms of the Roth 401k plan, but it may be possible to take a so-called non-qualified distribution, which just means you either haven't had that Roth 401k for at least 5 years, or more likely you're just under age 59 and a half. That's the big one, right? Generally speaking, if you take money out prior to age 59 and a half as a non-qualified distribution, which it's going to be if you're under age 59 and a half, what you have to do is you have to look at the Roth 401k in its totality. And the tax law says that thing has two components. The first component is your old contributions, right? So whatever the old contribution amount is, that's one component of the Roth 401k. Second component, all the earnings inside the Roth 401k. So let's imagine an example where you have a Roth 401k, it's worth $100,000, and you've made $70,000 of contributions through the years to that Roth 401k at work, and then that's grown by $30,000, so now we're at $100,000 of value. And say that for whatever reason, you take a non-qualified distribution out of that Roth 401k of $10,000. What's the result from a tax perspective? Well, the tax laws say you have to blend those two components together and allocate the distribution, that $10,000 distribution in my example, between those two components. So 70%, 70,000 divided by 100,000 total, 70%, 7,000 comes out as return of contributions, totally tax-free, totally penalty-free. But where you get some not so good results are, well, 30% of that distribution is a return of the earnings inside that Roth 401k. So that's $3,000, 30% of $10,000. That is, generally speaking, subject to both income tax and a penalty. 10% penalty, $300 in that case. We don't like that result, right? So we're generally trying to avoid non-qualified withdrawals from Roth 401ks because if there's been any growth, we're going to suffer both tax and a penalty in most cases if we're taking a non-qualified distribution. Well, what to do then, right? What you generally want to do is if you're looking to take money out of a Roth 401k prior to age 59 and a half, and that's something you want to think about long and hard before you do it because you're losing out on tax-free growth. But if you ever had to take one of these non-qualified withdrawals, you actually do have some planning techniques available that could avoid that tax and penalty. And the main one is, and this is especially applicable after leaving employment at an employer, is simply rolling that old Roth 401k into a Roth IRA. The Roth IRA has different distribution rules. And what happens is the Roth 401k goes inside that Roth IRA as two different things. In my example, $70,000 goes in as Roth IRA contributions, and $30,000 goes in as Roth earnings. Okay, we don't like Roth earnings, but recall the Roth IRA rules that I've previously done a video on. Guess what happens? That $70,000 of Roth contributions comes out first before we ever withdraw earnings in a non-qualified distribution. So guess what? If we were to take $10,000 out of that Roth IRA, we're now going to have $10,000 of withdrawals of all old Roth contributions, and it'll all be tax and penalty free. So the Roth IRA tends to be a lifeboat if we're ever needing to take out money out of a Roth 401k. And again, you ought to think long and hard about that, before age 59 and a half. But if for whatever reason you had to, you could think about doing this maneuver, get the money inside a Roth IRA, and then do the distribution so that's a return of old contributions and tax and penalty free. Lastly, a lot of your Roth 401ks are ultimately heading to a Roth IRA anyway. Why is that? Roth IRA is not subject to the required minimum distribution rules during your lifetime while you build up a Roth IRA in your own name. That thing won't be subject while you're alive to required minimum distributions. Roth 401ks, interestingly enough, are subject to required minimum distributions. So most folks want to get that Roth 401k into a Roth IRA before age 72, regardless, to avoid these RMDs, to keep that tax-free growth going as long as possible. I hope you liked this video. If you liked it, please mash that like button. Helps the channel very much. And please subscribe to the channel. See you next time.